Welcome to Top 3 Bob. I'm Bob, helping you towards your goals of becoming healthy, wealthy, and wise. Today, the title of the program is A Billionaire's Advice on Investing, and that billionaire would happen to be Warren Buffett. I have been investing for 25 years, and in my limited circles, I have never met a financial advisor who can consistently pick winning stocks. Actually, not even close. Most of them actually aren't very good at it. So I've always relied on my role model, Warren Buffett, to try to help guide me. And this is his advice for the beginning investor, or the investor who he believes is not capable of picking stocks, which is most people. The first thing he says, which is obvious, is to stay out of debt. I mean, you can't begin investing if you're in debt to any large extent. You certainly don't want to have any credit card debt, which at 18%, you could never surpass that debt that you're losing. For example, imagine what it would take to make 19 or 20% on a stock. So your time is much better spent paying off your debt first before you start investing in stocks. But once you've paid off your debt and you have some extra money to invest in a mutual fund, what he recommends is index funds. And I'm not going to explain to you what an index fund is. It's kind of beyond the scope of this program. But let me tell you this. I have been reading about financial investing for the past 25 years as stated. And in that time, all the top advisors always recommend the index funds because those index funds tend to perform better than the individual stock pickers and also better than the regular mutual funds. So you're going to want to invest in an index mutual fund, and I'm going to have another video on how to invest in a Vanguard mutual index fund. So you may want to look for that. So after you invest in the index fund, you want to make sure you're doing it on a regular basis, and you want to make sure you just leave it alone. You want to pretend you don't even have the money. Which also means you're going to have to ignore the news media, because the news media, especially when things begin to go bad and the economy begins to sour, the news media will make it sound as though the next Great Depression is coming, and maybe it is. And even if it is, you still should leave your money in this mutual index account. Charlie Munger, who is Warren Buffett's partner, stated that at any one time, especially if you're young and you're investing in stocks, you should be willing to prepared to lose 50% of your value. So if you have $100,000 in your mutual index fund, you should be willing to lose 50% of it, which is $50,000. Because eventually, with time, it's going to recover and do much better. So you got to have the right mindset to invest in index funds. Now, there are index bond funds, which are a lot less volatile. So you don't necessarily have to follow that rule. If you're more of a conservative investor and don't want to risk 50% of your investment at any one time, there are less volatile investments that you can jump into. And I will talk about that when I do that Vanguard Index Mutual Fund video. So I hope you find this information helpful, and I hope you will subscribe to me. Thanks.